Hi, I'm Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services, and I'm bringing you another episode of our market update. So allow me to show my screen here, and we'll begin. All right, so February update. It's the first time in 2 months I've been before you here. Talking points are pretty similar, though. We'll talk about inflation, interest rates, and the economy. We'll go into some detail about each. A few bullet points before we start shuffling slides. We got new CPI data, and that's the Consumer Price Index. It's one of the most widely followed gauges of inflation in our economy. Came down to 6.4% annual rate last month. Still elevated. That's still quite a bit, but it's a lot better than it was last summer, at 9%. One of the reasons that it didn't drop further, and I think there was some disappointment there among economists and investors, was because shelter inflation is still at 8% and rising, and that's a big component within the CPI. Shelter means just the cost of rent, and they do a funny little contrivance where they say, like, okay, what if there were no actual homeowners and everybody had to actually rent their homes? You know, what cost would that be? So it's I call it contrived, and I think it is. It's also lagged, by about 6 months or something. So, being 8% and rising, does it bother me? Absolutely not. If you look at more market-based or real-time measures of the cost of rent, like Zillow's rent index, it says that we're looking at about a little less than a 7% inflation rate, and it's falling like an absolute stone. So I'm not really worried about that. Another component of inflation is average hourly earnings or wage growth, and that dipped to 4.4% inflation rate annualized versus 5.4 last June. So this is one of the big check boxes that the Fed wants to check. Are they tightening the economy or financial conditions in the economy enough to get wage growth down to a more normalized level? And so it's stubborn, but it's coming down a little bit. Interest rates, well, I'll talk to you a little bit about this disagreement that Fed and the investment community had until very recently here, where the Fed kept saying that we're going to keep rates rising until we get above 5%, and then we're going to stay there for the balance of the year. Investors at first said, we don't believe it. We think you're going to crush the economy and you'll have to lower interest rates. But we're at a point now where investors are sort of throwing up their hands and saying, okay, you win. That's probably what's going to happen. So we'll put a finer point on that in a second. Economic growth. The simple way to say this is that the economy has been far more resilient than I think most economists and investors expected even 6 or 8 months ago. We've got some core economic strength here that's making the Fed's job harder. Remember, what the Fed is trying to do is attack inflation by attacking demand. They want consumers, they want businesses to stop spending willy-nilly, to be a little more cautious, and that will help drive prices down in the economy. Fed is still saying the consistent message is, we'll knock down the economy to stall speed, basically to zero growth, in order to get that done. Now, finally, and I think just the conclusion to this is going to be that everybody is reassessing the economy's landing. Like, what is it? Are we really going to be knocked down to stall speed, or are we going to be knocked into a recession? Or are we going to have any landing whatsoever, because the economy is pretty resilient? Okay, so let's get into the details here. And I showed you last time this slide, and it's got a list of items in the economy where prices are falling versus where prices are rising. So we'll hit this again. A gallon of gasoline is flat over the last year. And the national average, I think, is about $3.40 a gallon. Not if you, however, live in California or Hawaii, you're probably looking at $4.70 to $4.90. Anyway, nonetheless, gasoline is not near the issue that it was 6-8 months ago. Cost of moving a 40-foot shipping container from Shanghai to LA is still, even now, falling at an 80% rate versus a year ago. And that rate has been the same over the last couple of months now. Used vehicles, finally, used car prices are coming down. Yeah, they went up a little bit here in January, but on a year-over-year basis, down 11%. And that's good. Major appliances, definitely in disinflation. In other words, prices are falling, down 4% year over year. Televisions and smartphones, huge price drops, especially for smartphones. So those prices are definitely falling. And you'll notice that this list on the left is primarily goods-based. These are tangible things you buy or move. On the other side, what you're looking at mostly are services. Healthcare insurance, finally, that inflation rate's coming down. I think last time I shared this, it was rising at a 13% annualized clip. Restaurant meals still rising at 8% year over year. Auto repairs and airfare up 25%. Dry cleaning 6.8%. And daycare and preschool, I added this one about 5.9%. Anyway, these rates are far above normal, and it's in the primarily services. So this is the issue that the Fed has. That it's having a hard time bringing inflation down for services. Yeah, goods, absolutely. Goods are falling, but it's services that are a little more stubborn. So the Fed is continuing to raise interest rates, and that's the orange line here. And they have stopped raising them at 0.5 or 0.75% each time, but the stairs are still stepping upward. The Fed funds interest rate, which is their policy rate, is up to 4.75%. And as I said earlier, it's probably going over 5%. I want you to notice the blue line, though. This is the 2-year Treasury note yield, or the the interest rate that you get if you buy a 2-year Treasury bill today, and that's about 4.6%. Anyway, it makes sense that this interest rate should march higher with the Fed funds rate, right? Every interest rate through the economy over the last year has sort of marched north along with the Fed funds policy rate, and that includes mortgage rates, auto loan rates, small business lending rates, everything. Okay, but notice here in the November through January timeframe where the 2-year Treasury note yield falls, and yet the Fed funds interest rate is still rising, and that's that disagreement. Investors were worried that the Fed was going to do too much and drive the economy into recession, and that would mean lower rates. And so, investors sort of took their foot off the gas with regard to interest rates, bond yields, and bond yields kind of came down. But as I said in the opening here, investors are sort of crying uncle and saying, okay, all right, you're right. What you say you're going to do is probably what's going to happen. And there's a couple of reasons for that. One is that it does look like the Fed is serious about raising to above 5%. And second, it looks like the economy may allow them to do it. So let me get into that a little bit. You've heard a lot in the news media about tech company layoffs by the tens of thousands. We're talking, Google and Microsoft and Amazon, companies like that. And of course, companies that are, sort of on the brink. If you're dealing with buy now, pay later, or crypto, or anything like that, it's probably way worse than in terms of layoffs. But big picture, if you just want to step out of those articles and news stories and look at the whole country, I just don't see it. So the first chart I'll show you on the left here is open job positions in this country, and that's measured by the Bureau of Labor Statistics. The simple fact is that we still have 11 million open job positions in this country, and only 6 million people are classified as unemployed. So that's not normal. It means that the job market is still very tight. The chart at the right has to do with new claims for unemployment insurance benefits. And so these are measured weekly and put out by the Department of Labor. On the left-hand side of the chart, they're pretty high because, you know, the economy is trying to recover from COVID, but we're really just bumping around the bottom. And I can tell you at like a 194,000 weekly tally, that's historically very, very low. So again, the job market is very tight. And because everyone who wants a job has got a job, basically, consumer spending is still relatively resilient. And this comes in spite of the fact that inflation is still pretty elevated. This chart is retail and food service sales, and it's a percent change from a year ago. Are you growing? Are retail sales growing, or are they contracting? You can see a lot of craziness in this chart. In 2020, you can see that this just massive dip in retail sales because we were all afraid and confined to the house. And you can see on the right-hand side of that, though, this is everyone being let out of the house and the end of the healthcare crisis, that massive spike. So this is a great microcosm here. This is a great picture, rather, of all the craziness that's happened to us in the last several years. But we've settled out, and despite the higher inflation, you can see that retail sales are still up 6.4% from last year. Now that is an interesting number because it exactly matches the CPI rate, or the inflation rate. So roughly, I will say that in rough terms, consumers aren't buying any more than they used to, but they're keeping up with rising prices. And so there's no real sign of huge distress if you look at consumers as a whole. That is great. Okay, so what are the implications? You think over the last 30 days, as I said, the data has gotten stronger. The economy is pretty resilient. Inflation's coming down, but not as fast as the Fed wants. And so it's all about the landing. I get the implications for the future. All the way on the right, a hard landing again means that the Fed is successful in bringing down inflation, but they sort of tighten financial conditions hard enough that it drives us into a pretty serious recession. I am crossing this out because it looks like over the last couple of months, this is more of a remote possibility and not at all a probability. And so I'm crossing that out. You may remember if you came to one of our client appreciation events last fall, we were calling for a bumpy landing, meaning a lot of volatility, but no serious recession. And that 2022 and probably the first half of 2023 were almost throwaways before we got a sustainable recovery in asset markets. We thought there was a very small probability of a soft landing, meaning that yeah, you'd have a slowdown. You'd probably bring the economy to stall speed, meaning a period of time where there's zero growth and everyone's businesses and consumers are sort of retrenching and more cautious. But you know, the market would sniff out a recovery at some point this year. And then I have to say though, and this was completely off our radar, and I think most investors' radar in 2022. There's a possibility that we could have no landing. What does that mean? It means that the wheels aren't even down on this jet. It's not coming down to stall speed. It's not, you know, inflation's not coming down to the 2% Fed target. Economic growth is not going to zero. And there are a couple of implications I want to talk about regarding the possibility of that. I'm not saying it's a probability, but you've got to talk about it now that the economy looks to be very, very resilient still. All right, there's two lines here in this chart. blue and orange. And all this means is the blue is expected inflation, average inflation over the next 2 years. And the orange line is expected inflation over the next 10 years. Okay, so the Fed's target is 2%, long run, right? That's what they say. And it's probably no coincidence here that investors believe, the orange line here, that over the next 10 years, long run, probably it will average about 2.3, 2.4%. Great, okay. But the 2-year chart, while it was early this year down around 2%, it is spiking. What this is telling you is investors are starting to price in the possibility of no landing. That is, next 2 years, we're expecting average inflation of 3%. And these are bond traders. They're betting, they're putting their money where their mouth is. And so this brings about another disagreement between the Fed and investors. When investors are saying, we don't think you're going to be able to bring it down to 2. And so there's two possible outcomes here of this argument. Okay, and the first possible outcome is that the Fed says to itself, well, you know, we may not be able to bring down, the economy is so resilient, we may not be able to bring down inflation to 2% in the next 2 years, but it's okay. As long as we get it on that path where we believe in the long run it'll hit that or close to that, we'll be okay. And they might even raise their medium-term target from 2% to 3%. I believe that's a probability. I think they'll probably do that. The other alternative outcome, though, is that the Fed says, nah, we're doubling down on monetary tightening and rate hikes because we're having a really hard time believing that we can get inflation down right now to, you know, toward that 2% target. So that would mean more pain in stock and bond markets, clearly in commodity markets, housing markets, in every market. Okay, I don't think that's a probability, but there's one or two outcomes to this. At the moment, you know, you look at the stock market, and the stock market looks like it agrees with us. First of all, you just see a lot of nonsense here, huge volatility over the last 3 years. But since October, the stock market is up off of its bottom, and we're what they call climbing a wall of worry, and that's the best wall to climb in the stock market. In other words, you're not going straight up. There's a balance of views. There's positives, there's negatives, and investors are cautiously bidding the market up. You can see there's some setbacks here, but we're cautiously bidding the market up because investors are always looking forward, and they are guessing what I just said, that we may have a very low chance of a hard landing and some chance of some significant chance of either no landing or a soft landing. So that's why we're up off the bottom. But you know, we're not out of the woods yet, and I think this really jagged upward line shows you that there could be more volatility ahead. I think, you know, for my part, I'm having a harder time believing that that the other shoe is going to drop, that we're going to go retest those October lows anytime soon. I just don't see that in the data or the trends that I'm looking at. So for now, I think we're you know, cautiously optimistic that again, this could be the year where you get the end of two very significant cycles, the end of the hyperinflation cycle and the end of the Fed rate hike cycle. And that if that's the case, if, you know, say by mid-year, it looks like the case, capital markets could very well be in the clear. Of course, you know, we can't wait that long to be invested because by the time everything's cleared, markets have already adjusted. And I think that's the lesson of this entire recovery is the market is always expecting and adjusting those expectations, not trading on today or tomorrow or next month really, but trading on what they think is going to happen in the next 6 to 8 months, maybe a year. We're happy to bring this update to you. Here's a few disclosures, and Thank you very much for watching. We'll be back in a month with more.